With the price of Bitcoin just passing $100,000 USD, this will hopefully see your crypto investments rise. With rising investments comes rising profits, but also probably means comes rising taxes. What can you do to reduce your taxes during this crypto bull run? Let me explain a few basic strategies that you can implement, and I'll end with one more advanced strategy that requires a bit of future planning. So let's start with the real basics, and we need to understand how is crypto taxed. So obviously, if you understand this well, skip forward to the next section. But for those that want that bit of a refresher, I think understanding the basics of how it's taxed is really going to allow you to save tax by understanding what is actually happening. So in Australia, we're going to get taxed on crypto to crypto transactions. So that means if you own Bitcoin and you switch it over to Ethereum, then that is going to give you a taxable event because you have changed asset A, which was Bitcoin, to asset B, which is Ethereum. So let's use the example where we buy some Bitcoin. It's worth $5,000 when we buy it. So that is our cost base. We now go and switch that over to Ethereum when it's worth $8,000. So we've now made a $3,000 gain there. We then go, oh, actually, no, we want to move back to Bitcoin. But the price has moved a bit again, and now it's actually worth $8,500. We now move that back to Bitcoin. So all that's really happened, we now have Bitcoin. It's all we ever had, but we just happened to move it in between. But we've actually had two taxable events during that process. So we had a $3,000 gain we made that first trade, and a $500 gain we made that second trade. So we've actually made $3,500 worth of gains, even though we never seen any of that back in our bank account. We're only moving between crypto. Now what happens, you lodge your tax return, and assuming you're on, say, the 32% tax bracket, you end up with a bill of about $1,120 in tax. Now, maybe you don't have that access in cash, and now you've got to sell more investments that have gone up in value again, and now you're going to owe tax on them, and it can come in a bit of a loop. So understanding when you're going to get taxed is really important to being able to save tax in the long run. This moves really well into my next section, which is talking about the timing of your sales. So understanding the timing of your sales can really help. And the first big part of that is that these are capital assets. So in Australia, if you hold a capital asset for over 12 months, you get a 50% discount. So in that, for example, you've obviously moved the assets around a lot very quickly and therefore aren't going to hold them for 12 months. If you instead had held that Bitcoin, that $5,000, and you just held it till the time it got to $8,000, for instance, and it had been over 12 months and it gone up by that $3,000, you would get a 50% discount. So that gain drops down to only $1,500 that you're going to pay tax on. So you can see this can be a great saving by understanding the timing. Now, the big thing with the crypto market is it moves very quickly, so you might not be able to just wait on timing of assets. You need to consider timing and tax as a part of your overall investment strategy. As you get close to the end of financial year, timing can also come into play because maybe you want to push out the sales for the new financial year, or maybe you want to bring them forward to this financial year. Understanding where that falls and when you're going to sell and when you're going to be taxed on it is also really important to your overall tax saving strategy. Now, something else you can do to help you better understand taxes and therefore hopefully save tax is to subscribe to my free newsletter. I drop a newsletter every single week just with some tax tips and talking about what's going on in the world of tax, reminding you of some deadlines and also some business tips involved in there as well. I'd love you to subscribe. The link is in the description of this video. Now let's talk about using losses. Now hopefully your investments are all in profits, but we know that is not how it typically works. You'll have some winners and some losers. So what actually happens with those? Well, these will be capital losses, and capital losses can only be offset against capital gains. And this is really important to understand because it means if you've lost money on a crypto asset, you can only offset that against other capital gains. Now the great thing is this is across all different assets. So you might have made a really big gain on property, but lost some money on crypto, well, you can offset their losses there. Or maybe it's the other way around, you sold some shares in the past, but now you've made some gains on crypto, and you haven't utilized those shares, those losses have been rolling forward, you can then offset these against your crypto gains. Just remember that losses are applied before the discount's applied. So if you have a $3,000 gain that has been held for over 12 months, but you have a $1,000 loss, you need to apply that loss first, bringing that down to $2,000, and then we apply the discount from there. So remember, because losses only can be offset against capital gains, you can't offset them against other income, such as your wage. So this is where you need to consider that timing and understanding your losses to help save you tax. So say you've made a $10,000 gain on a crypto asset, but you've also got another asset there, another crypto investment, that's at a $2,000 loss, but you haven't sold that yet. You might want to sell that asset in the same financial year so that you can recognize that $2,000 loss and offset it against the $10,000 gain. And the reason for this is because if you do that in the same year, you're going to end up with an $8,000 gain. However, if you split them over 2 years, so we take our $10,000 gain in this year and we don't sell our $2,000 loss until next year, but we have no other gains in next year, well, that loss can't be utilized and it has to be rolled forward until you eventually have a capital gain. So by doing that in the same year, you're utilizing that loss much quicker. So by understanding these little things, you can definitely save yourself big. So by understanding these little things, you definitely can save yourself some tax. But one of the best ways to save big is to get your structuring right. And this is a bit more challenging because if you've already got your investments, it's much harder to fix this. But that is something you want to ask yourself before you go and make that next investment. Is your overall structure right? Where does this investment need to go? Let's look at a bit of an example here. And we take someone, they make an investment in their own name, and they make a $20,000 gain on their crypto. And now they're going to get taxed on that. But they already had an income of 300 grand. So they're going to be taxed at the highest possible marginal tax rate plus the Medicare levy. So they're going to be paying 47% tax on this. They're going to pay $9,400 on this gain. Now, their spouse isn't actually working. They're a stay-at-home parent and they're not working, and they had no other taxable income. Now, if we had put that investment in their name, for instance, or in a trust that then distributed to them, they might have paid no tax on this at all. So just by getting that structuring right, we're talking a $9,400 difference on this gain. So you can see, getting your structuring right can save you thousands upon thousands of dollars. So you need to ask yourself, what other income has everyone that could potentially benefit this got? And are we putting the investments in the right name? Are they going to go in your personal name? Are they going to go in joint names? Are they going to go in a trust? Are they going to go in a company? You really want to understand all these different structure options and work out which one is best for you. And different investments might fall into different buckets depending on where you are at the time you're making the investment. But if you get this right from the start, it's much easier. It's very hard to fix this once the investment's already been made, because in most situations, to move them to a different entity is going to be a capital gains event anyway, which might defeat the tax purposes. Structuring is complex though, and if you do want to understand more about it, I've got a full video coming up here where I talk about the best structures for your investments, how all the different types of structures work, and how to decide which one will be right for you. I hope you enjoyed this one, and I hope to see you over there.